Okay, so in this video I'm going to do some problems that you will see in, these are sample problems similar to what we'll see in exam 1. Keep in mind that this is not everything that will be in exam 1. It's just some sample problems. I try to do most of the problems in this video, and a lot of the conceptual stuff you'll just go to the review sheet and you'll have most of the conceptual stuff. Okay, so I'm just going to review some of the sample problems that you're going to have on the test. So these are very similar, not exactly alike, but they're very similar. Okay, so let's take a look at the first one. First one says if operating cash flows equals 12,000, assets equal 750,000, liabilities equal 450,000, and the firm received $100,000 from the issuance of a bond, what is stockholders' equity? Well, this question is a little bit misleading, okay? Because it's giving you more information than you need. In order to calculate stockholders' equity, all you need is assets and liabilities, okay? So you could ignore operating cash flows and you could ignore the $100,000 from issuance of bonds, right? If you recall, the formula for the balance sheet equation, the accounting equation says that assets equals liability plus stockholders' equity, right? So if we know that we have assets of 750,000 and liabilities of 450,000, what's stockholders' equity? Very simple, 750 minus 450, right? Assets minus liabilities equals stockholders' equity. It's the same thing. You just do a little bit of algebra here, right? So 750 minus 450 is 350, okay? Remember, assets is everything that the company has, and liabilities is stockholders' equity is how are they financed, who owns a portion of each. So of all my assets, of the $150,000 in assets that I have, 300,000 is all paid for by me, and 450,000 I owe to other individuals outside the company. Those are my liabilities. That you could view as liabilities and stockholders' equity as to how the assets were funded. Okay, so as an owner, as a common shareholder, I own $300,000 of my 750,000 in assets. Okay. Remember the example of the house. If you have a house that's worth $750,000, and you paid the bank $300,000, you still owe the bank $450,000, right? That's your mortgage. Or another way to put it, if the house is worth $750,000, but you have a mortgage for $450,000, your equity is $300,000, right? Equity is what you actually own of the whole thing that the company is made of, or in this case, in my example, of the house, right? So this question was very easy. You're going to have to remember this formula, and you could also apply a little bit of algebra. So the algebra that we applied here is that assets, oops, let me make this black. Assets minus liabilities equals stockholders' equity, right? It's the same thing as this up here, but with the variables shifted around. Okay, so let's go ahead and do another problem. Okay, this says a firm's statement of changes in stockholders' equity shows an ending total stockholder equities balance of $110,000 at the end of 2015. In 2016, the company issued new shares for common stock of $60,000, reported a net loss of $5,000, and paid dividends and paid $4,000 in dividends to their shareholders. The firm's 2016 statement of changes in stockholders' equity will show an ending stockholders' equity balance of, okay, so there's two main formulas that we have to remember. I already mentioned one in the in the first problem, that assets equals liabilities plus stockholders' equity, right? So stockholders' equity is the portion of your company that you actually own, right? That part, that's mine, that I paid for. Okay, how does equity change? Well, equity changes various ways, right? You start with beginning equity. Then to that if you bring in more money, then that's going to increase equity, right? With new shares. If you repurchase some of those shares, that's going to take out the equity that's out there. If you pay your shareholders dividend, that's going to take out the equity. And of course, if you make net income, well, that increases your equity. If it's a net loss, it's going to decrease your equity, right? So this is the equity formula. Ending equity is going to equal beginning equity plus any new shares issued minus any shares repurchased minus any dividends given to the common shareholders plus net income. If it's a net loss, you subtract it, okay? So let's prepare this little chart here to see if we can get our answers. Let's see how I organize this. Okay. So let me just put all the numbers there, okay? So this says a firm statement of change holders and stockholder equity shows an ending total stockholder equities balance of $110,000 at the end of 2015, okay? So at the end of 2015 you had 110, then obviously on January 1 you started off with 110,000. That's what you started off with, right? It says the company issued new shares of common stock for $60,000. So that adds to your equity. That's more money that came in. Okay. Reported a net loss of $5,000. We'll put it here as a negative. And paid $4,000 in dividends. If you pay out $4,000 in dividends, that's going to reduce your equity. Okay. So is saying what's my ending equity. So this is very simple, right? They're asking for this here. All you have to do is take 110, add 60, subtract 4, and subtract 5. And that'll give you your answer. Okay, and the answer will be 161,000. So remember, memorize this formula here, and you can solve this problem very easily. Okay? Let's go ahead and do a couple other problems. This one here is on accruing interest. Okay, so let's read the problem. It says on December 1st, let me go ahead and delete all this and I'll start from scratch. So on December 1st, 2016, Carlson Corporation purchased $90,000 treasury note. Okay, so they purchased a treasury note. They bought the note. That means that they gave the money, which means that they will be receiving the interest, right? Okay, so they purchase a note for $90,000 that pays them 12% interest. Okay, they're going to receive the 12% interest plus their $90,000 back on November 30th of 2017. So they'll receive it after a year, right? Carlson's fiscal year ends December 31. What accounting entry will Carlson do on December 31st? Just because they received their $90,000 cash on November 30th plus the interest, that doesn't mean that they going to do an accounting entry only on November 30th. They have to accrue for the interest that they've earned in the year that they've earned it, right? So how do we do that? Let's do this. Okay, so the note is for $90,000. So the note is for $90,000. That's the principal, 90, 1, 2, 3, right? Let's go ahead and format this, 90,000. And it says that the interest interest is going to be 12%. Okay, let's make this a percentage. The interest is 12%. Okay, so what's the annual interest? What's the total interest that they're going to earn on this? Annual interest is going to be equal to 90,000 times 12% is 10,800 for the full year, right? But they purchased this on December 1, and so they're going to accrue interest, the interest that they earned on December 31st. From December 1 to December 31st, how many months have gone by? 1 month, right? So you're going to accrue the equivalent of 1 month. What's the equivalent of 1 month? Well, 10,800 divided by 12, right? So every month you're going to accrue $900 in interest that you've earned, right? And that's going to be called interest monthly. We'll call this monthly interest revenue. Okay? Monthly interest revenue. Okay? Okay. So, let's just go through all the accounting entries. December 1st, I bought the bond, right? So I purchased a bond for $90,000. And let's say I pay for it cash. So my cash goes out, right? Bond goes in, cash goes out. $90,000. Perfect. Now, this is December 1st. Now on December 31st, I want to let my investor know how much interest I've earned on that bond for this year, right? Did I receive the cash for this bond? No, I'm going to receive the cash on November 30th, but I still have to recognize the revenue for 1 month. I've already calculated that. It's going to be 900. So what I'll do is I'll book an interest receivable on December 31st, right? I'm expecting to receive this, and it's going to be for $900, and I'm going to recognize interest revenue on that month. $900. Okay, so that's the accrual of interest that I have for December 31st. On December 31st, I accrue 1 month of interest. Okay, now because the fiscal year ends December 31st, you have to do this entry here, because you want to recognize the revenue that you've earned in the period that you've earned it. So you've already earned $900 in interest revenue, therefore you must book it in the correct year, $900. Once November 30th comes by, you will receive your cash back, and you will go ahead and close the interest receivable over here. Okay? So that one is quite simple as well. And if you don't understand it, just ask me in class. Let's do the last one. Okay. Let me go ahead and delete this. It says Smith Company received $24,000 cash advance as payment for an office it will lease for a full year, 12 months. What's the original entry at the end? What's the original entry and the entry at the end of the first month? Okay, so what's going to be the original entry? You received $24,000 in cash, right? So let's put 24,000 over here. That's what you received. Is that revenue for renting? Is that rent revenue? Absolutely not, because you haven't earned it yet. So what is that? If you receive $24,000 in cash, but you haven't earned it yet, you owe somebody $24,000. Now you could give them their cash back, right? You could pay them back their $24,000, or you could pay them back by providing the products or services that you promised. In this case, you're promising rent. You're promising the usage of of an office, right? So as your customer, the person that gave you the $24,000, uses the office, you will be earning your money. So it says this is for a full year, 12 months, and they pay you $24,000. So how much are you charging them per month? Well, that's easy. 24,000 divided by 12, you're charging them $2,000 a month, right? So you're going to earn $2,000 a month, but you haven't earned it yet. So the original entry, you got cash and you have a liability. Unearned rent revenue is a liability. Why is it a liability? Because I owe this customer $24,000. I could either give it to the customer back in cash, or I could give it to the customer back in whatever I promised them, product or service, okay? So the original entry would be something like this. Cash, 24,000, and then unearned rent revenue, 24,000. Okay, that's the original entry. Okay, so as every month goes by, as you saw, we earn $24,000. So when 1 month goes by, at the end of the first month, you recognize $2,000 in rent revenue. Sorry, revenue has a balance on this side, right? $2,000 in rent revenue, and you reduce your liability. You no longer owe this customer $24,000. So you lower it by $2,000 every month, right? So the entry is going to be equal to, you're going to lower your unearned rent revenue by $2,000 and you are going to go ahead and recognize rent revenue, because now you've earned it, by $2,000. Okay? You're going to do that every month until you've earned your full $24,000, right? So you're going to do that for 12 months. Okay. So once you do that for 12 months, can't remember, let's see if this is 12 months. 18, I guess this is 12 months, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So once you do that for 12 months, you're going to lower this for the full 24,000. You'll no longer have a liability. This will close at zero. Let's move this aside just so that you can see it. So you do 12 here as well, right? Let's see, right? 12 months here, it's 24,000. So what's going to be your balance at the end of 12 months? Your balance is going to be zero, right? 24,000 on the asset side, 24,000 in the liability side. You no longer on the debit and on the credit side, so now your balance is zero. You've closed this account and you've recognized $24,000 in revenue, okay? But the question said, what was the original entry? This is the original entry, and the entry at the end of the month is this one, right? Every month you're going to do this entry. You're going to recognize a portion of your revenue, okay? So those are our samples. Let's do more examples of problems to be that you might expect in the first exam, okay? Let's read this one. As of the end of its accounting period, December 31, year 1, Great Plains Company has assets of $840,000 and liabilities of $350,000. During year 2, stockholders invested an additional $53,000 and received $23,000 in dividends from the business. What is the amount of net income during year 2? Assuming that as of December 31, year 2, assets were $925 and liabilities were $370. So let's analyze all this. We have a little chart here that probably will be helpful. Let me see if this has the actual. Okay, so it doesn't have anything behind it. So let's build this. Okay, I could write assets here. Oops, this is not. I'm gonna have to make everything black. Okay, there you go. Assets, liabilities, and stockholders' equity. Okay, so when it says as of the end of the accounting period, December 31 of year 1, you know that the beginning of year 2, which would be January 1, is going to have the same information, right? End of December 31 is the same. 2016 will be the same as beginning of the other year in January 1, 2017, right? So if this company ended December 31 of year 1 with $840,000 in assets, it began year 2 with the same thing, $840,000. 1, 2, 3, right? And they had liabilities of $350. So this is all the information that I have and that I know. Let's continue to fill in the information. During year 2, stockholders invested an additional $53,000. Okay, so what does new shares do to equity? New shares increase equity, right? Well, we don't know what equity is here. Well, let's just fill in the information. New shares increase equity by $53,000, right? So let's put the $53,000 there. And receive $23,000 in dividends from the business. Dividends decrease equity, right? Because dividends is money that leaves the company and is given back to the shareholders. Let's put this negative because it's going to decrease equity. In accounting, when you see something in parentheses, that means that it is a subtraction. It says, what is the amount of net income? That's why I have it highlighted in yellow. During year 2, assuming that as of December 31 of year 2, assets were $925 and liabilities were $370. Okay? So the first thing we want to do is fill in the blanks, right? What's stockholders' equity in year 1? Well, that's very easy. We follow this formula. We know that assets equals liabilities plus stockholders' equity. Therefore, stockholders' equity must equal asset minus liabilities. So what's assets minus liabilities? 840 minus 350 is 490. Okay, so that's my stockholders' equity for year 1. And we'll do the same thing for year 2. At the end, stockholders' equity at the beginning of year 2, right? As the question says. And what's stockholders' equity at the end of year 2? Same formula. Assets minus liabilities. Okay, 555. So we went from 490 and we went up by 555. Okay? We know that net income is at the end is added to equity. So it's going to be part of the formula. Increasing equity, right, as part of retained earnings, right? Because if we look at the formula here, we see that ending stockholders' equity, which is the 555,000 equals beginning stockholders' equity plus new shares minus shares repurchased. There was no share repurchase here, so we don't have to worry about that. Minus dividends, which was 23,000, plus or minus net income or loss, right? So that's what we're trying to find out. Okay, so this formula here, we use this information down here. That's what's applicable. And we could use algebra for that, right? So what does this say? My ending stockholders' equity, 555. 1, 2, 3 equals beginning stockholders' equity 490. Sorry, 1, 2, 3. Plus new shares issued plus 53,000, right? That's the new shares issued. Shares repurchase is not part of the question, right? So minus dividends, minus 23,000. Plus or minus net income. We'll put an X because we don't know what net income is, right? Plus or minus X, okay? So we know that 555, this is equal to this, plus this, minus this, plus or minus this. If it's positive, it's going to be plus, and if it's negative, a loss, it's going to be minus, right? So we don't know. We'll just put a plus X. And we're going to go ahead and isolate X to find out. It's just very simple algebra. You move it over here to the other side. All these. Once you move it to the other side, you'll find out what X is, right? So let's just move them to the other side. 555, 1, 2, 3. When you move the numbers to the other side of the equals, you make them the opposite sign. So 490 becomes negative, right? Minus 490. And then the 53 becomes negative as well, minus 53. And the 23 becomes positive, plus 23. And that's going to equal X, or your net income. Okay, so now you just solve for X. And you will know what your net income or loss was. Okay, and I'm just going to do it over here. Let me put here something like X. Well, I'll just write it out. Net income, which is X, equals, right? And let's just put the formula in here. 5. Well, I'll just do it here. 555, right? Minus 490 minus 53. Okay. This here is negative, so I need to put it as a plus. So I'm just going to do 2 minuses, make a plus. I hope I don't confuse you. But that's plus 23. Okay? Dividends are subtracted. Let me put it this way. You got to remember that dividends are subtracted, right? You just don't want to confuse you, so let me just put it positive there. So let's go back to what I was doing. Net income is going to equal this minus the ending stockholders' equity minus beginning minus new shares issued plus the dividends, right? So net income must have equaled $35,000. If we plug $35,000 here, you will notice, let's make this negative again. Well, I can't make it negative. It's going to ruin this here. But if you do that, you will notice that 490 plus 53 minus 23 plus 35 is going to equal 5550. I'll do it here just to show it to you. This plus this minus this plus this is 555, okay? So just remember, learn these two formulas and you'll be able to get net income from here. If I give you net income and ask you for dividends, it's the same process. If I give you dividends and net income and ask for new shares, same thing, except that your X is going to represent whatever I'm asking for, okay? But you use the same similar process, okay? Let's do the next example. This is not a problem, but it's something I want to stress that you need to learn. You have to learn this if you want to do a basic simple accounting entry, okay? What goes up with what? Okay, let's assets go up with debits, okay? So I'll put an arrow there. Liabilities go down with debits. Equity goes down with a debit, right? Revenues go down and expenses go up, okay? So the two in the corner go up with debits, and the three in the middle go down with debits. The opposite is true if you look at the credit side, obviously. Assets is going to go down with a credit, and these three are going to go up. Liabilities, equity, and revenues. And expenses are going to go down with credits, okay? You need to know this if you're going to do a very basic, simple journal entry, right? So you can just let's see how else we can say, okay, up. What brings them up? Up. Or I could say normal balance. Normal balance. That's the side that usually brings the account up. For this one, it's debit, right? For these are credit, right? Credits bring these up. Credit. Credit. And for this one, it's debit, okay? So you could also do it this way. Assets go up with debit, expenses go up with debit. Liabilities, equity, and revenues go up with credit. You could put a debit or a credit in either one of these, but what brings them up, we also call that the normal balance. You have to know this. There's no logic to this, it's just memorization. Assets go up with the debit side, expenses go up on the debit side. When we do T accounts is something that we simply use in academics and to show things, okay? So the left hand side always represents the debit and the right hand side always represents the credit, okay? So typically if it's an asset, you're going to typically see the balance on this side, right? The balance is always typically is going to be on the debit side. And then let's copy this. Let me do this. Paste. 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 Wish I had a little bit more space here so that I could fit another one in. Let's see if I could fit one in here without. Not sure I'm going to be able to fit one in. Maybe I will. Let's see. Paste, right? So liabilities, equity, and revenues, and expenses. Okay, these have their normal balance on this side. Okay, so this is typically where you're going to find the balances on the credit side. Typically, sometimes we'll put an entry on the other side. There's nothing wrong with putting an entry on the other side, but the final balance, you're typically going to find it on those sides. Okay, so these are the sides that bring these type of balances up. Okay, just learn that because it's going to be very important. Actually, the next exercise we're going to see how we apply that. Let's see. Yeah. Okay, so let's take a look at some examples of some journal entries. It says company purchases equipment for $10,000 cash. Okay, so what's the entry that we're going to do there? There's no expense here. You're simply exchanging one asset for another, right? The asset that you're going to get is equipment, right? And equipment is going to be worth $10,000. And what's the asset that you lose? Well, the asset that you lose is cash, right? So cash goes down by 10,000, equipment goes up by 10,000. You're exchanging one asset for another. Remember that I told you that assets go up with a debit, so you put a debit in equipment to bring it up, and you put a credit in cash to bring it down. The company prepays 12 months of rent in advance for $12,000. In other words, their rent is going to be $1,000 per month, and they're going to pay it all in advance, right? For the full year, January 1 to December 31. Okay? What related entries would be made at the end of January 31, 2017? Well, let's just do the entry first on January 1. On January 1, do you have an expense? The answer is no. You don't have an expense. You haven't used any value. No value has left your company. You've simply exchanged cash, right? So cash goes down by 12,000. You've exchanged it for the right to use a certain, I don't know if it's a building or a room or something, for 12 months. So you've gained that right. So that's an asset as well. We'll call it prepaid rent, right? Just like if you have a prepaid phone card, it's not, you haven't lost value. That has value, right? So the fact that you can use rent for 12 months, that has value. So if you exchange one asset, cash for another asset, prepaid rent, okay? Now, once you use a portion of this asset, prepaid rent, you must recognize the expense, right? Because you've used a portion of it, and so you must recognize it as an expense, right? At the end of January, we've used how much of this $12,000? We've used the equivalent of $1,000 worth, right? So we're going to go ahead and do what we call an adjusting entry. We're going to adjust the prepaid rent. We're going to recognize the rent expense for 1 month, right? What's one month equivalent of rent expense of $12,000? Well, that's going to be $1,000, right? It says it here, $1,000 per month. And so we're just going to bring our asset prepaid rent down by $1,000, okay? If I did a T account representing prepaid rent, you will notice that prepaid rent began with 12,000, right? That was this entry. It's an asset that has a value of 12,000. Assets go up with debits, right? And the left side represents debits. And then you're going to bring it down by 1,000. So the net value of prepaid rent at the end of January 31 is going to be 11,000, right? 12 minus 1. Okay, and this is what's known as an adjusting entry, right? Because you're adjusting your prepaid rent balance. Let's take a look at another account. And I'll bring this down in case I have to use it as an example for this other one. Okay. Okay, it says company performs services worth $10,000 and is paid in cash. Well, the word says it. They're paid in cash. So you're going to receive cash of $10,000, and says company performs services worth $10,000. They performed the services worth $10,000. So they completed the services. So this is going to be sales revenue. No, not sales, sorry. Service revenue, right? It's revenue that they earned for services that they performed. Okay, so you have service revenue of $10,000. Let's take a look at this other one because they're related. D. Company performs services worth $10,000 to be paid in 2 weeks. Okay, so in this case, they're going to be paid in 2 weeks. So in this case, you use the accounts receivable because you're expecting to be paid. You haven't gotten the cash yet, $10,000. But notice what we put here. We're going to put the exact same thing, service revenue, because we are doing what we call accrual accounting. So you're going to recognize revenue whether you receive the cash or not, as long as you earn it. To record revenues earned, even though we did not receive cash, we record revenues because we earned it, right? So these two things have book service revenue the same. One of them you receive cash, the other one you didn't, but it doesn't matter. You're still going to book service revenue here. We do accrual accounting, not a cash accounting. So we're going to book our revenues regardless of whether we got paid in cash or not. Okay? And then when we get our money back, we simply, when we get paid, we simply get our cash, right? 10,000, and we close the accounts receivable. Notice how if you combine these two accounts, the net effect is going to be similar to this one, right? The cash is going to be here, service revenue is going to be here, and this receivable is going to wash each other out, right? So the accounts receivable is just a temporary way of recognizing revenues until you receive the cash, because again, we're doing accrual accounting. Company purchases merchandise worth $6,000 and pays immediately. Okay, so they purchase merchandise, so their inventory goes up, right, by $6,000. It's not an expense yet because they're just getting inventory. And cash goes down by $6,000. Okay, company pays for the merchandise purchase the following week. Well, if you paid for it, I'm sorry, this is not cash. It says, oh yeah, it pays it immediately. Yes, it is cash. Company purchased merchandise worth $6,000 to be paid in a week. Okay, again, first you put the inventory which you got, right? But you haven't paid it yet. So instead of putting cash, you're going to put accounts payable, right? $6,000. Once you pay, you put accounts payable here because you went ahead and paid the you paid what you owed, right? So you close the payable. Okay. And then the cash goes out. Okay, so over here you've closed your accounts payable, and it's just like buying inventory with cash, right? But this one occurred 1 week later. Okay. Okay, I guess I forgot to delete this one. It says company takes out a loan of $15 from the bank. So you got $15 in cash and you have notes payable. Notes payable is a liability. Notice a liability goes out with a credit. Okay. You could also use the account long-term debt if the debt is for long-term, right, over a year. It says company pays employee $14,000 on January 31 for the work done up to January 31. Well, they did that. They pay on January 31, and the work includes work up to January 31. So you're going to pay everything that they earned, right? So if you pay in cash, cash goes out, right? $14,000. And wage expense is $14,000. That one is easy, right? Very straightforward. It says the employee earned $14,000, so you pay it and you record it as an expense, right? The full amount owed is paid. No problem. But let's take a look at how we handle something a little different. Company pays employees $10,000 on January 31 for the work done up to January 31, right? So $10,000 represents work done up to January 31. But an additional $4,000 was earned by the employee and will be paid in a week, okay? So for whatever reason, we're not paying an extra $4,000. So in this case, notice what's going to happen. Is the expense the same? The expense is the same because they earned it. The employees earned it, right? So in this case, the expense is going to be $14,000. It's going to be the exact same thing. And here we paid the full amount that the employees earned, and here we only paid them 10. But since the employees earned it, we're going to recognize the same expense, right? But we only paid $10,000 in cash. You know what? By the way, I did this backwards. I apologize. Company pays. If you saw this, I'm glad. God. So I did this backwards, right? If I pay, what goes down, right? If I pay, my cash goes down. And as we know, expenses go up with a debit. Somebody should have yelled through their computer and told me that. Come on, guys. Okay, that was just a bad joke. Anyways, cash goes down by $14,000, right? Because the company paid. So it goes down, and I apologize for that if you were confused. And wage expense goes up. Expenses go up with a debit, right? Okay, so let's go back to that same example. I'm glad I caught that. Wage expense goes up here too, but my cash goes down. How much did my cash go down by? In this case, in example I, it only went down by $10,000, right? And then I owe the rest. So I could put either accounts payable. I rather put it under wages payable, right? Wages payable. And how much do I owe? $4,000. Not sure why it didn't come out the same color, right? So, my cash went down by $10,000. I owe $4,000, but my employees earned the full $14,000. So that's my expense, $14,000 here, wages expense, same as here. Okay, again, under accrual accounting, you are going to record the expense when it is incurred, regardless of whether you paid for it or not, right? Okay, so those are some examples of journal entries, and so let's continue here real quick. We're going to do some bank reconciliation, and if you don't understand bank reconciliation, I will advise that you look at the video that explains bank reconciliations before I do this problem, okay? It says Rogers Company gathered the following reconciling information in preparing its May bank reconciliation. Calculate the adjusted cash balance per books, okay? So, in bank reconciliations, you're going to compare your bank statement with your books. I'll put GL, General Ledger books, right? This is the company books. This is the company books, and you're going to compare what your bank statement says you have in cash. But you have to make adjustments because there's timing differences between both sides, okay? So in this case, they're asking us for the book side, right? Not the bank side. So we're only going to work with the book side here. It says cash balance per book is $5,000. 5, 1, 2, 3, right? That's what we start off with. Deposits in transit. Is that a booked adjustment or bank adjustment. This is a bank adjustment. This goes here, so we do not include it in our formula. This is what we're calculating here, because that's what it's asking for. It's asking for the balance per book, not per bank. Okay, so make sure that you do not mix these up. So do not use this here. It says notes receivable and interest collected by the bank. Okay, this $600 was collected by the bank on my behalf, and I did not find out about it until I got my bank statement. So it's not in my books yet. I'll put it in later, but for now I'll just include it as an adjustment, right, on my side, because I have to put it in my books later. Interest collected by bank on my behalf. Okay, so that you put bank charges for check printing, another thing that's not in my books yet, but that I have to put because I haven't booked it yet. I only found out about this after I received my statement. So I'll put these in later, but for now I'm going to make my adjustments manually. Okay, bank charges. That's another. So this is another adjustment that's done on the company side. Okay, outstanding checks. These are checks that you wrote to a customer. You took them out of your balance, but the bank has not, the customer has not presented it to the bank. So the bank has not taken them out yet. Okay, this would be an adjustment to the bank side. Just like deposits in transit are an adjustment to the bank side. Deposits in transit are deposits that you made, that you gave your courier to send. You booked them in your books, but the bank hasn't credited you yet. It's just a timing difference, right? Okay, so these two are bank adjustments. We don't worry about those to get the answer to this question. NSF check. NSF check is a check that you got from one of your customers. Okay, you put it over here. But what happens? You found out from the bank that now it doesn't have sufficient funds, right? So the bank did not credit you your money because that check did not have sufficient funds. So you're going to go ahead and take it out again. You have put in it up here, but now that you found out that it didn't have the funds, you take it back out. Okay, so my ending adjusted balance per my book is $5,460, and this would be your answer. You have to get 5,460 here as well, right? But we really can't solve this here too. Well, I guess we could solve it. If these were the only two entries, I guess I could go backwards and find out what my beginning balance was, right? But I'm not going to complicate it. This was what we were asked for, and that's how you collect it. Okay, that's how you calculate it. Notice that you do not include deposits in transit. That's a bank statement adjustment, or outstanding checks. That's a bank statement adjustment. You should include the other three to come up with your adjusted cash balance per books. Okay, let's do the next one. Kroger uses the allowance method to calculate uncollectible accounts. At the end of its first year of operations, December of 2016, it estimated $10,000 of their receivables would not be collected. Kroger has not reserved for uncollectible accounts before this. The proper adjusting entry to account for the uncollectible accounts would be, okay, again, there's a video on this. Watch the whole video so that you can understand what I'm doing, okay? So let me just do the accounts before. So if I come over here and I say that my allowance for uncollectible accounts has a zero balance, right? So I have an allowance for uncollectible accounts. Let's do it like that. It has a zero balance, okay? And it says that I estimate that $10,000 of my receivables are not going to be collected, right? This is a contra asset account, so I want this to have a balance of $10,000 here. I want to have an allowance of $10,000 here because that's what I estimate I'm not going to collect in the future, but I want to book it today, right? What's my offset? My offset is going to be bad debt expense, right? Bad debt expense. So I want to recognize as bad debt expense in this period what's going to potentially occur later on. And I estimate that $10,000 of my receivables I'm not going to collect. I want to create sort of a reserve for that. So this is the proper entry to do. You're going to record bad debt expense here. That comes on the debit side, right? Because expense have debit balance. And you're going to create your little reserve called allowance for uncollectible accounts, okay? Or allowance for bad debt. It doesn't really matter to me what you call it as long as it makes sense. Or so you could call it allowance for uncollectible accounts, allowance for bad debt, or provision for loan losses, or I'm sorry, not provision for loan losses, that's a different topic. Okay, so this is the proper entry to show that. And you can see how it affects each account. This is an income statement account. You're going to recognize expense of $10,000, and you will have your allowance of $10,000 here. Okay. Okay. Next example. Let's try to do this fairly quick. It says Jacobson has credit sales of $8 million. During 2015, Jacobson's December 31, 2015 allowance for an uncollectible account was $50,000. Okay? So let me do that again. Maybe I could just take it from here. Copy and paste it over here, right? Let me copy paste. So allowance for uncollectible account had a balance of $50,000, okay? So that was my balance. But I want to adjust this, okay? Because this is not the balance that I want, okay? Before the adjusting entry, under the percentage of sales method and using 1% credit of sales as an estimate of bad debt, what amount, if you hear these alarms, please ignore them. I mean, I guess my office is not very good at avoiding the outside noise. Anyways, so it says I'm going to use the credit of sales method, right? And I use 1% of credit sales for the year. What amount of allowance for uncollectible accounts should Jacobson report on December 31, 2015 after the adjusting entry? Okay, so what's going to be my adjusting entry? Well, I used the percent of sales, right? I sold $8 million, right? I sold $8 million. Let me do this over here. I sold $8 million. And I want to go ahead and add 1% of this to my balance over here. So that's very easy, right? 8 million times 1% is $80,000. That's what I'm going to add over here. How do I add that? Well, my bad debt expense is going to be $80,000. Okay, I do that with a debit. And my allowance for uncollectible account, I'll just add that there. Allowance for uncollectible accounts with a credit, $80,000. Okay. So this is going to come over here, right? 80,000. Okay. So what's my ending balance? That was the question, right? says, what amount of uncollectible accounts should Jacobson report at December 31 after the adjusting entry? This is the adjusting entry. So after that, my ending balance is going to be very simple, right? $130,000, right? $130,000 is the ending balance. The other account that got affected in this transaction, let's go ahead and do the T here just so you can see it, was, let's take this out, was the income statement account, right? Called bad debt expense, okay? $80,000. So if I ask you, what was the bad debt expense for that year? Your answer is $80,000. If I ask you, what are you going to report as your allowance for uncollectible account? It's going to be $130, right? Because the 80 was added to the initial 50, okay? Good. Let's move on to the next one. We're almost there. Two more. This one is using the, we can't see it here very well, so let's do this. Wrap it. Okay. And let's wrap it up. Oh, okay. Now we can see the full question. It says, in 2015, Jacobson had credit sales of $8 million, the same as before, right? And we have the same balance over here, so let me go ahead and copy it over here. Let me take this and copy it, because there's a lot of similarities in this question. And in fact, let me copy everything. Copy. Again, there's a video on this, so please watch the video before you even do these problems, because if you watch this problem, me doing this video first without watching the video on allowances, you're not going to understand what I'm explaining. Okay, says Jacobson has credit sales of $8 million during 2015, and allowance. Jacobson's December 31 allowance for uncollectible account was $50,000. So they have $50,000 here, right? Okay. Before the adjusting entry, under the aging of receivables method. So this is another method. And under this method, what we are going to calculate what goes down here. On the other method, we calculate what we added to the 50. Under this method, we're going to calculate what we want as the ending balance. Okay, that's very important. It's a very big distinction. Okay, very big distinction. Okay, so this is what we're going to calculate first, and then from there we'll be able to determine what the bad debt expense is going to be, what the entry is going to be. Okay, let's take this entry over here. Let's put it here. Okay, so my point is the following. Let's go back. This is not okay. So we're going to calculate this first, so that then we know what this is, which will be this entry here. Okay, so how do we calculate this under the aging of receivables method? It's very easy. You're going to have the schedule up here. It's going to tell you the amount per days outstanding, and you're going to apply a certain percentage of uncollectability. Notice that the longer they are outstanding, the higher the uncollectability ratio is. That makes sense, right? Because if a customer hasn't paid you in over 120 days, it's more likely than not that they're not going to pay. So you apply a higher percentage of uncollectability, okay? So we're going to shoot for this balance here, and you'll see how we get it. I'm going to highlight it here. It's very easy. 400,000, we're going to apply a 2% uncollectability, so that one is going to be 8,000, right? The 150, we're going to apply 5% uncollectability, so that's 7,500. Let's give this the same format. Okay. The 120, we're going to apply a 10% uncollectability. So we take 120 and we multiply it times 10%. And we do the same thing over here. 100,000 times 15% uncollectability. Okay? Then we take all these and we add them up. So Oh God, this is a horrible example because it's lower. Let me change this. I don't like this example. Let me change this to 200,000. See if I make it higher. 200,000. Okay, that's better. I don't want to complicate things for you. Okay, I want it to be higher. So my total reserve is going to be 57,500, right? So that's the number that I want down here, right? But that's not going to be my entry, right? 57,500 is not my entry. My entry is whatever I need to put here to make this end up at 57,500. And it's quite obvious. I need to plug in 7,500. So that's going to be my bad debt expense, right? So my bad debt expense, I'm going to put 7,500 and 7,500. So if I ask you what the bad debt expense is, the answer is 7,500. If I ask you what the balance for uncollectible accounts should be at the end after the adjusting entry, it's 57,500, right? You would have had the answer right down here. You wouldn't have to have done the second step, but the second step is necessary to adjust the balance over here. Okay, let's do the last one. Last one, and this should cover an enormous amount of examples that are going to be for the test. It says in June 16, Memorex wrote off accounts receivable for Jarrett Corporation for $3,000. Memorex uses the allowance method. What entry should Memorex make to record the write-off? Okay. So what entry should they do to record the write-off? And so let me go ahead and now, if you had a write-off, if you use the allowance method, that means that you already had an allowance account, right? You already had a balance here, allowance for uncollectible accounts. Let me use this as the example, okay? So you had already reserved for the receivable that Jarrett isn't gonna pay, okay? So instead of expensing it, you're just gonna use your reserve, right? You're gonna take it out of here. Allowance for uncollectible accounts. You're gonna take it out of here, 3,000, and you're gonna go ahead and close Jarrett's receivable. Okay, so accounts receivable Jarrett, and you're gonna close it, right? Because Jarrett, let me show you the other side of the equation very quickly. Because you had a sub account for Jarrett, right? You have an account receivable as well, right? So let's do this. Account receivable Jarrett, right? Jarrett had his account here for 3,000. But now we're not going to collect it anymore, right? So we're going to close his account here. Jarrett Corporation's account to 0. We don't expect collection from here. And we're simply, instead of expensing it, we're simply going to take it out of our allowance. Okay? So those are various examples that are going to be in exam 1. If you know all these examples, you should do well in the exam. Okay? Thanks. Bye.